Let's get in a perspective on how foreign investors are viewing the region and in specific how they are viewing India. We've got Richard Gibbs, who's Chief Economist at Macquarie. He joins us on the show from Sydney. Richard, to begin with, what's the sort of economic landing that you are forecasting for China? Some are predicting a hard landing, others a bumpy one, and the rest a soft landing. How are you recommending clients to position themselves in China, and also why are you doing it that way?
Now, we still believe there'll be a soft landing, probably bringing it in around 7.5%, if not 7.75%. That'll be very satisfactory. For the doomsayers who believe that China only has one more soft landing in its arsenal, we believe that, well, that may be the case, but this will be the soft landing. And we think that's consistent with everything we're seeing. As I say, unless you really are of the view that policymakers have shifted towards a low-growth model, and we think that's highly unlikely, given that Hu Jintao and Wen Jiabao in particular are very conscious about their legacy in relation to economic management.
Sean, Richard, last week we saw a bit of a rebound in the markets across the board. Do you think that the worst has already been priced in, and will the markets be in a range from now on, or are you going to see an upward bias from these kind of levels?
Look, I think the worst had been priced in. I think the worst had been priced in when we actually saw the big sell down and the big flight to quality, particularly to US dollar denominated assets. However, I think what we're now going through is the disappointment trade, as it's been called overnight, and that is that I don't think Euro policymakers are going to move on the same time horizon, time frame that the markets are anticipating in relation to resolving the Euro debt crisis. So I think there is going to be disappointment, but I think in terms of moving us away from the abyss, if you like, yes, certainly I think the worst in relation to that scenario has been priced into markets. Markets have been through that and now moving to a much more measured, albeit gradual approach.
And Richard, what's your view on the dollar index, which saw strong gains recently?
Yeah, the strong gains recently in the dollar index are interesting, but from our work, almost 90% of those gains is attributable to basically safe haven flows, and that is really investors looking to preserve capital in an environment of increased sovereign credit risk coming from the euro area. And we didn't see really any of those funds flows or moves based on a belief that they were moving in to the US dollar market to pick up undervalued assets at this point in time. Now, that is a necessary process that we do need to go through, but we're some way off that at this point in time. So the flows we saw really were safe haven flows designed to preserve capital.
And the environment of late also has been averse to risk assets. What do you see by way of flows, and is there panic at that level?
I don't think it's panic, but it's interesting you mentioned that. We were talking about this morning around the desk, and what we're not seeing is we're not seeing new funds flowing in, particularly to equity capital markets. So we are seeing cash positions being maintained. We are seeing switch trading going on, so that is people are having to sell something if they're wanting to buy another security or another company, and we're not seeing any net new flows of money or lifeblood, if you like, into the market generally, and that's a global phenomenon. So we're seeing a lot of churning and a lot of pair trading and switching going on, and at this point in time I think that's likely to be sustained until we see much stronger macro guides.
But Richard, do you expect a year-end rally in emerging markets versus developed markets despite the problems that we're seeing in the Eurozone?
Quite right. We've got to pick up yield as they move forward if they're going to come anywhere near index or even outperform it. And I think also we note that on the private equity side, you know, we've had talk of up to $1 trillion of dry powder in relation to the funds in private equity hands. So really these players have got to move to try and find value. My suspicion is, yes, they're going to play the emerging markets probably more aggressively towards the end of the year. They are high beta markets, as we've spoken about before, which means that your bang for the buck, if you like, in terms of uptrends in the market is much greater than playing the mature markets.
And do you see a differential trade within the emerging markets, where markets such as India would draw more value-led investors than some of the other markets like, say, Russia and Brazil?
Well, certainly India should draw more value investors, because this is a longer-term structural change story in India, one of formative development. in a market that I have to say is performing reasonably well in terms of its defensive sector, mainly because it's actually made major progress in the development of private consumption, domestic demand in the economy, and that's being reflected through industry sectors on the stock market there. So I think, yes, that those investors who are looking for deep value are looking to come in and buy stocks and sectors that have been oversold with a longer-term growth and economic development view, if you like, will be well placed in the Indian market.
But also, Richard, what are you expecting in terms of monetary tightening in India as far as when the Reserve Bank of India meets towards the end of the month to decide on?
Well, I've been a hawk through 2011 and been on the right side of it, but believe it or not, we think now that there's likely to be a pause. The reason for that is that we are seeing growth ebbing away. We suspect we are going to see a reduction in the growth momentum, probably down to 7.5% in annualised terms for the Indian economy. We also believe that we're seeing a peaking out now in the WPI, about 9.7% annual, and as a consequence of that, we suspect that the authorities will be apt to actually pause at this point in time, just have a look at the impacts on growth as we move forward. Obviously, they've got the upheaval we've been seeing in global markets, which has quite substantially affected funds flow, particularly portfolio capital funds flow into the Indian market.